Hello, this is Jim Bell with Bell Investment Advisors. I'm certified financial planner, founder, and chief investment officer. Welcome to our investment committee update today. The title being a question: are the brightest days still ahead? I'm joined by Corinne Salera Bedford, certified financial planner and portfolio manager and investment advisor on this presentation for today. Thanks for doing this with me, Corinne.
Of course, thank you.
This title, the question, is really motivated by the fact that in some ways, in spite of everything, the U.S. markets are continue to make all-time highs, and our clients wonder, how long will this continue? Is this the top? Can things continue to get better? So that's what we're going to cover today from many different aspects. If you have questions as we go through the presentation, or if you have questions right now, you do have a question box on your screen. You could enter those questions. Corinne and I will try to answer them live. If we're not able to do that, we'll certainly get back to you with the information you're asking about. You see our 800 number at the right-hand corner of the screen there. If you're having any difficulties, call our office at 800-700-0089. So let's get started. Here is an overview of it's not working. There we go. Here's the 5 basic areas that we're going to talk about: U.S. earnings growth, consumer confidence, trade disputes and agreements, international equities, and Corinne has some comments about U.S. monetary policy and the bond market.
I do, yes. So again, Jim and I have the privilege of presenting our investment committee update webinar on the same day that the Fed has come out and announced another interest rate increase. So that's what happened today. The Fed raised rates for the 8th time since December 2015. And after another 0.25% increase today, the new federal funds rate target is now 2 to 2.25%. We will discuss the implications of this later on, but I did want to mention, I thought this was very interesting, that Fed Chair Powell, during the press conference, his comment was that the U.S. economy is experiencing a particularly bright moment. So I think that's very timely, and Jim and I feel good about the title of our webinar based on his comments. So we'll start off today by highlighting the strength of the U.S. companies. So the U.S. companies, based on the largest 500 in the U.S., had a very strong earnings growth rate for Q2 2018. It was up 25% from a year ago, which is very, very solid, with a historically high beat rate, which means that companies were exceeding their earnings per share estimates at a historically high rate of 80%. Generally, that rate is around 70%. But 80% is a historical high. So we think that is important. We're also encouraged by the estimates coming out for this quarter, Q3 2018, coming in around 20%. Companies are benefiting from a lower corporate tax rate and high consumer demand, which we'll certainly discuss more later on. Back to you, Jim.
Thank you. So one of our key conclusions is covered on this slide, that, as I said, U.S. stocks continue to claim all-time highs, and in spite of all the things that there are to worry about, the trade disputes, the escalating trade war with China, domestic political instability, all these factors can weigh on people, but what we're seeing in terms of behavior is that investors are betting on the strength of the domestic economy to rise above all these breakdowns in global trade and other concerns and worries. So anxieties that investors may feel about stock negatives are allayed by strong market fundamentals, and this is what we are continuing to see. Continuing on this front, under the heading "Economic Strength Conquers All," tariffs are not having the expected negative effects that we may have feared they would. And as Corinne just mentioned, with another Federal Reserve interest rate hike today, investors are really taking this in stride, viewing it as confirmation of U.S. economic vigor. So that underlying economic strength is more important than this very gradual trend that the Federal Reserve is on to normalize and raise interest rates. Some more strong points: unemployment at the lowest level since year 2000. Jobless claims have fallen to a 49-year low, and wage growth is accelerating. So I had the good experience of listening to an interview by Target CEO Brian Cornell, who's 60 years old. This was on CNBC a week or two ago, and it was pretty stunning what he said, that he believes we're in the best consumer environment that he's seen in his 35-year career. It's quite a statement coming from a successful veteran of retail. Target just reported the best quarterly results in more than a decade, and its shares have increased 33% this year. And this hits close to home to me because my 11-year-old granddaughter, Target is her favorite store. So she's right on trend here. And continuing with Target, U.S. consumer is really showing their muscle. These retailers that were once maligned, especially last year, the retail outlook and environment was really dismal. But Target has experienced its strongest same-store sales growth in 13 years, and in balance, its digital sales are also up 40% compared to a year earlier. And what we're observing, and other analysts, is that many retailers seem to have found a sweet spot with very strong results in their stores and growing traffic online. And anecdotally, as I'm out and about, it just seems to me that the pendulum has swung a bit back to real physical shopping, being in stores, as well as strong activity online. Corinne?
Thank you. So Target is certainly not alone and benefiting from the strong consumer. Other retailers such as Nordstrom, Macy's, Walmart, Kohl's, TJ Maxx, and Tiffany also are reporting strong results this year. And as Jim mentioned, it's certainly a turnaround from last year when everyone thought that brick and mortar stores were going to be non-existent. Certainly retailers have adjusted. They've invested in their stores and also online capacity. And we think that's great. We're really thrilled to see these results. Why? The U.S. consumer is responsible for 70% of the domestic economy. So although trade seems to be controlling headlines at the moment and overshadowing this important stat that the strong consumer is really going to drive the U.S. economy. And it appears that this trend will continue with the U.S. Consumer Confidence Index near an almost 18-year high. I think that's a great stat. And the expectations are that both business conditions and incomes will be even better over the next 6 months. So that income stat, that's the last bullet point there, that's the highest we've seen since December 2000. So really across the board, consumer confidence bodes well for the economy. Jim, some more economic positives?
Sure. So As you may know, the gross domestic product measurement for the second quarter that ended June 30th originally came in at a print of 4.1%. And as always occurs, these numbers are revised up or down or stable as more time passes and there's more opportunity to analyze data and so forth. So in this case, the second quarter GDP was revised upward from 4.1 to 4.2%. That may not sound like a big move, but it's further confirmation of the momentum and strength in the U.S. economy. U.S. companies are spending on their businesses at the fastest pace in 24 years. U.S. companies are spending on their businesses at the fastest pace in years, up 24% from a year ago. And for the August report, U.S. factory activity expanded at the strongest pace in more than 14 years.
Turning back to fixed income and monetary policy, we already mentioned that the Fed raised rates again today. And certainly we have heard some concern about the bond market, given we are now in a rising interest rate environment. The 10-year Treasury yield is approaching a 7-year high, which would be 3.11%. We haven't actually hit that at close, so that's something we're approaching. But why is this concerning? Bond prices move inversely to yield. So the fact that we're in a rising interest rate environment could and has put pressure on bond prices, but that really is in the near term. That could be a near-term drag on returns. But we're not overly concerned for a few reasons. The Fed has remained committed to gradual hikes. Fed Chair Powell, he reiterated this message many times over during the press conference today. Another important data point is that international demand remains quite robust, given the U.S. has some of the highest or the highest yielding bond products globally. So that really should keep yields range bound. More importantly, however, a higher yield environment is not necessarily a bad thing, since most of the return of bond funds actually comes from yield. So overall, we think it's important to maintain a fixed income allocation if your risk tolerance warrants it. Most importantly, perhaps, is that it can act as a ballast to your equity allocation, since correlation between stocks and bonds is historically very low. All this said, we do think it's important to actively manage your bond exposure. What you see on your chart here is looking through the Bloomberg Barclays US Aggregate Index and looking at the credit rating of the corporate bonds within that index. It's comparing 2009, how that index looked then, to this year, 2018. And what you can hopefully see and decipher is that the lowest end of investment grade, that's looking at BAA, has actually climbed from 34% in 2009 up to 44% this year in 2018. Another data point we want to point out is that duration has also increased from 6.3 in 2009 to 7.3 this year. Duration, if you're not aware, is a way to measure interest rate sensitivity. So again, we just wanted to point out that we believe that there are some ways to manage these risks, both credit and interest rate sensitivity or duration risks, by leveraging actively managed bond funds. One other fixed income concept you may be privy to or have seen some headlines about is yield spread. With the Fed controlling the shorter end of the yield curve, we've seen the spread between the 10-year and 2-year shrink. And why does that matter? Well, you can see here in this graph, the blue line is tracking the spread between those two yields. And the gray bars are mark recessions. What you may notice is that when that yield inverts, meaning the 2-year yield is higher than the 10-year, that precedes recessions or has preceded a recession. We will note two things. We are not yet inverted. We are flattening, certainly, not inverted yet. And even if and when we do invert, there tends to be many months of lag between the moment of an inversion and a recession occurring. So this is something we are monitoring at least monthly during our investment committee meetings, but we wanted to share some information about it with you all here today.
So back to trade disputes and agreements. We wanted to include some of the threats, not just all the good news about strength, but the U.S. Federal Reserve has commented that the tariff situation is curbing investment, and it is raising input costs, which certainly are or could be a negative drag on the economy as a whole. Just today, the CEO of Ford Motor Company reported that the metal tariffs on steel and aluminum that the Trump administration executed cost Ford $1 billion of profit for this year, 2018. So that's pretty serious money. Economists surveyed by Bloomberg predict that the U.S. economy will slow to a 3% growth rate for the second half of 2018. We think if that plays out, it could be pretty dramatic, as investors and business leaders have become quite enamored of this 4% rate, GDP growth. So we are watching for what kind of reaction might come from certainly stock investors. If that kind of slowdown were to occur, it would also validate or support the allocation that many of our clients do have to the bond market for the sake of diversification and stability. Finally, trade tensions have definitely caused some businesses to scale back or postpone capital investment.
Honing in on the job market within the U.S., as Jim mentioned earlier on, the unemployment rate is at a level not seen since the late 60s. You can see that here depicted on this unemployment rate chart. And also jobless claims are at a historical level, as you can see here, compared to 2018 to late 60s. I'll let Jim quantify the data for us.
So you're probably aware that we're in the thick of the longest record of job growth, 95 straight months of positive job creation. The unemployment rate is at 3.9%, a significant historical low. And just recently, the August payroll reports, non-farm payrolls grew by 201,000, a good strong number, and further support and validation for the strength that we're seeing. Some more caveats on this theme of labor shortage. We've now seen the highest level of open jobs to jobless workers since the year 2000. Last time I looked, there's approximately 700,000 more job openings than there are jobless workers looking for work. So that's a tilted ratio. It looks like it's going to continue to grow, and it just represents missed opportunities for economic expansion to have job openings that go unfilled. Businesses are having a tough time finding and retaining talent, And another interesting aspect of this, I just saw a report in the last few days that in terms of military recruiting for the U.S. Army, it's down significantly. It being the situation that when young people have a hard time finding jobs and work, the military represents a good alternative for job training and education. And because there are so many job openings and opportunities, fewer youth are turning to military service. So there's some competition there. We think the anti-immigration policies are worsening the labor shortage, and the tariff wars have certainly hurt our farmers and our agricultural sector of our economy. And it's known that there are at least 1.2 million agricultural workers in the U.S. who are undocumented, who help harvest these crops. And the more strict we get about deporting those people, the greater hurt and damage is going to be to our agricultural sector.
So we certainly wanted to make sure we commented on international equities and the relative underperformance of international markets this year. But as the title of this slide indicates, we do believe there are still opportunities outside of the US. So looking at the chart here, it's graphing different indices across the world. In the US, the all country world index there in green, Europe, Japan, and emerging markets. So as you can see, really any exposure outside of the US has meant flat to negative years. And we certainly understand how a stretch of poor performance can be taken as evidence that these other markets should be avoided, but we don't believe that that is prudent. We think the diversification of having exposure outside of the US is very, very important. If you market cap the world, 50% of your money would be overseas, just to give you a sense of the exposure that's possible if you take that standpoint. So certainly be giving up diversification benefits if you solely focus in the US. Also, valuations are quite a bit better overseas. If you hone in on the forward-looking price to earnings ratio, valuations for international large cap stocks are 14 times earnings versus 17.1 within the US. So again, we could have an entire webinar on international equities. We want to make sure to comment and certainly reach out to your advisor if you have any more questions or concerns about your international exposure. I'll now turn it over to Jim with our conclusions.
So just to review some of the main points that we've made, certainly U.S. economic strength is rising above these trade disruptions. Investors are looking past that. The overall negative effects of the tariffs have been milder than expected. I'd like to point out that the U.S. economy is a 20 trillion plus annual economy, and what we're talking about in terms of tariffs that have been threatened and executed so far, certainly in terms of the execution with this upgrade or increase in the China tariffs, we're at about 2.5% of the U.S. economy. So it's just a relatively small percentage that's being affected by that $20 trillion number. Federal Reserve rate hikes are viewed as confirmation of U.S. economic strength. Rates are going up because the economy can handle it, and we need to get our debt and financial picture back to a more normal dynamic after all of the quantitative easing. Many have said that the U.S. consumer is on fire. That's one kind of dramatic way to say it. I just saw an interview with Mark Benioff, the founder of billionaire founder of and CEO of Salesforce, and his phrase was that the U.S. economy is ripping. And as he talks with many CEOs, he's just getting a lot of feedback about their confidence that comes from the corporate tax cuts. Couple of just kind of warning points is the tariffs. You know, it may be a short-term phenomenon, but if it does continue, I mean, it is something that could be resolved in the next 12 months or less. But if this continues, it is going to be a negative force in the economy and for investors. And the labor shortage, should that continue to go at the pace that it is, it could have a negative effect in a major way as well. Thank you for giving us your time. There's lots of ways to connect with us, and we always appreciate that. If you haven't submitted questions yet, you can certainly do that now, or you can contact us with some of the information that you see on the screen right now. We have recorded this webinar, and we will post it on our website in our webinar library within the next week. If you would like to have a copy of these slides, just separate from the posting that we'll do, you can request those, and we can send you out the PowerPoint graphics that we have used today. Our next investment committee update is scheduled for December 19th. Registration is not yet open, but we'll give you plenty of notice about that should you want to join Corinne and me again in December. Lots of ways to stay in touch with us. You can follow us on Twitter, LinkedIn, follow our blogs, email us. We always love to hear from you. So again, thank you, Corinne, for working with me on this.
Thank you. It's been great.
And we'll look forward to presenting to you again. Thank you very much.
Have a great day.